Charles Schwab Chief Investment Strategist Ann Sonders joins us now. Ann, thank you very much for being here. I mean, obviously, there's much commentary out there about today's action in particular. Do you worry that the rally following the Fed's rate cut could be indicative of a bubble, as B of A has suggested, and then it kind of got ahead of its skis?
I'm not sure we're at bubble level. You could argue that maybe back in mid-July when you had the severe concentration problem up the mega cap spectrum. But I think with the broadening out, and even at that time, you had at least marginally more reasonable valuations down the cap spectrum. You know, the last couple of days was interesting. It was almost a buy on the Fed statement, sell through the presser, and then buy on the open the next day. And I think that kind of day-to-day volatility is likely to persist. And obviously, it's not just uncertainty with regard to Fed policy, even though we've now started the easing cycle, but a lot of other uncertainty as we head into third quarter earnings season. And then the big elephant in the room being the election.
The election and obviously the economic data in between there, too. And when you see things like FedEx's earnings, for example, that's often seen as an economic bellwether, missing estimates, cutting guidance, does that suggest to you that there are potentially greater issues under the surface? And does that change the way that you're kind of collating your view on what's happening in the market and what's happening in the economy?
I think that there are leading indicators pointing to weakening growth here, particularly in the labor market. And that is why I think the Fed did this recalibration of starting with 50 basis points and maybe shifting a little bit more of their focus to through the windshield as opposed to the rear view mirror, and having that focus on the labor market, in particular, the hiring rate. So we're not seeing a huge increase in the unemployment rate. The unemployment rate, for the most part, has been going up because of labor force participation. We're not seeing a huge increase in layoffs. We saw yesterday still pretty healthy trend in both initial unemployment claims and continuing claims, but it's that hiring rate. And I think what the Fed is now keying off of in their cutting cycle is the growth side of the equation, the labor market side of the equation, basically the complete opposite of the hiking part of the cycle when they were solely keying off the inflation side of their dual mandate. So I think that there are signs of cracks in the labor market, maybe veering into the consumption side of the economy. And I think to some degree the FedEx announcement picked up on that.
I had this journal piece, Ann, looking at the Fed in the wake of the decision. Fed aiming to repeat Greenspan's 1990 masterpiece by staying ahead of the curve. I wonder if you think that's the neighborhood they're in, is sort of repeating really good economic chapters like that one.
Well, I think they would probably love to repeat the mid-1990s. Soft landings are less prevalent than recessions. And what we know in terms of Fed policy is a cutting cycle accompanied by a soft landing is much more rewarded by the equity market than a cutting cycle accompanied by a recession and or financial crisis. What's also interesting with regard to market behavior around sort of full Fed cycles is, I sort of bristle when I hear comments like, well, typically the market does, and then they fill in the blank with some average percentage performance number for the S&P in the, call it 6 months after the Fed starts cutting rates. But there have been a really wide range of outcomes. And where there is consistency is the mirror image of what the market did during the pause period and then what the market did once the Fed started cutting. The best performance in history, once the Fed started cutting in the 6 months subsequent to the initial cut, was in 1974. But that was in part because of the carnage that preceded that. The market was incredibly weak during the pause period leading into that initial cut in 1974. It was the complete opposite in 2006. Once the Fed started cutting in 2006, the ugly stuff was still ahead of you, but there were record, at least in the pause period, gains for the market in that pause period. So, and for what it's worth, this pause period that we just completed, the period from the final hike more than a year ago to the first cut, that is the best performance in history for that pause period. I'm not saying we're going to automatically get the mirror image, but history may provide some guidance there.